Good evening and welcome to HSBC Premier's 2022 Market Outlook virtual event. We are very glad to have you all here today. While we wait for the rest of the attendees to join in, allow me to share with you some housekeeping information. Participants' audio will be muted during the session, but we very much welcome questions from the audience. If you have questions as the session goes on, please post them via the Q&A tab function located at the bottom of your control panel. Your questions will be answered through the Q&A tab, or they will be answered live by our speakers in the second half of today's agenda. Good evening to our distinguished guests. Ladies and gentlemen, welcome and thank you for being here with us today. My name is Joanne Teo, investment specialist from HSBC Bank, and it is my pleasure to be your moderator for the night. We are very excited to be discussing the market outlook for 2022. For today's agenda, we'll open the event with a welcome by Chong Wing Fong, the Head of Investment Specialist for Wealth and Personal Banking, HSBC Bank Malaysia, along with Patrice Consica, CEO of HSBC Asset Management. We will then begin with the main event, that is the market outlook for year 2022, with Alexander Davey, Global Head of Active Fundamental Equity Product and our Senior Product Specialist in Asian Equities. Speaking along with Alex is Renee Chen, Senior Economist and Investment Strategist at HSBC Asset Management. Just as a reminder that should you have any question, do feel free to put them in the Q&A tab as mentioned earlier. The questions will be addressed during the Q&A session in the latter half of the event. Without further ado, please join me in welcoming Wing Fong to kick us off.
Ladies and gentlemen, a very warm welcome to everyone joining us this evening. It is my great pleasure to welcome you all to our first market outlook for 2022. On behalf of HSBC, I would like to thank you all for your participation. So the beginning of 2022 marks 2 years since the start of the pandemic, and what an eventful time it has been. We have had an economic recession and subsequent recoveries, during which the stock market proved its resilience, rising to new heights. Daily life has changed profoundly, with digital technology playing a deeper role in how we work, consume, and interact. I'm excited to hear from both Alexander Davey, our Global Head of Active Fundamental Equity Product and Senior Product Specialist, Asian Equities, and Renee Chen, Senior Economist and Investment Strategist at HSBC Asset Management, on what 2022 has in store for us, their investment outlook, and key investment themes for the year. I'm also particularly keen to hear how these mega trends will help us identify risks and new opportunities in order for us to adapt and move forward with a stronger strategic direction in our investment. Before I pass the floor to Patrice, the head of Southeast Asia and CEO Singapore of HSBC Global Asset Management, I would like to take this opportunity again to express my deepest thanks to our speaker today, who have taken time out of their respective busy schedule to speak with us, and to every one of you for spending the next hour or so with us. I trust everyone here tonight will make good use of today's sharing session. Thank you for your time, and over to you, Patrice.
Thank you very much, Wing Fong, and thank you to your team for putting together this event. Good evening, everyone. Thank you for taking the time to be with us today, and I'll take also this opportunity to wish every one of you an excellent year in 2022, full of success, health, and prosperity, I hope. And on this latter point, I have to say, in my little more than 30 years of experience as a professional investor, this is really shaping up to be an interesting year and an interesting juncture in investment markets. Of course, on the negative side, there are no shortages of uncertainties and fear-mongers out there with issues like, of course, the pandemic, but perhaps some other ones that were less mentioned in the previous couple of years, like inflation, worries about asset valuations, geopolitical issues, and various other uncertainties like monetary policies, for instance, among the chief concerns. All of these getting lots of mention in the press recently. And yet, I must say that I do find much to like in the markets right now. For instance, I think it's always interesting to see how the prospect of higher policy rates tends to bring perceptions of closer to reality, really, when it comes to growth expectations, when it comes to valuations. So what I'm saying here in plain English is that whenever rates are expected to rise, that means that bubbles tend to be kept in check. They even tend to deflate, or at least not to inflate further. And trust me, this is actually quite healthy. And equally, in challenging markets comes the opportunity for investment professionals to show their skills, be it through increasing selectivity, very disciplined investments, smart diversification, all of which lead eventually to good performance and risks being managed. And trust me, I have absolute trust in the ability of our investment teams to shine through all of this. Now, there's another point here that's really worth emphasizing, which is, as you may know, we are huge proponents of sustainability, climate transition, and generally speaking, ESG, i.e., environment, social, and governance considerations. And we have been for quite some time, for instance, by being one of the very early signatories to the UN, United Nations Principles for Responsible Investments back in 2006. So at HSBC Asset Management, we are putting sustainability at the center of every investment decisions we make, alongside more traditional investment considerations like profitability, creditworthiness, or growth. And I have to say, this is one of the things I find really interesting in the market right now. I'm delighted to see the ongoing and rising interest about those topics. And I think this is not going away anytime soon and is really becoming central to investment considerations. So here we are. We're not even yet in the middle of the first months of the year, and it already has been a pretty interesting investment year, and it's shaping up to become even more interesting in the next few months. So to discuss this more in detail and share our views in that respect, so I'll be very happy to introduce my colleagues Renee Chen and Alexander Davey, who have been mentioned earlier. Don't be fooled by their useful looks. Between the two of them, they probably have substantially more than 50 years of investment experience. And so, again, thanking you for your time and attention. Without further ado, Renee, over to you.
And good evening, everyone. So I'm very pleased to be here today to share with you our latest views on the global economy and investment markets. We have titled our 2022 outlook, The Price of Success. So here, I want to elaborate a bit more on what we mean by this. So over the past 18 months, we have observed major macro successes with the fastest economic recovery on record and strong market returns, given success in policy response to the pandemic, including, say, the delivery of macro stimulus, innovation of vaccines, and new environmental policy initiatives. However, success also comes with costs. So we think in 2022, investors will face a payback period in terms of lower economic and profits growth, higher inflation, greater macro uncertainties, more market volatility, and reduced asset class expected returns. So from policy normalization to a more bumpy shift towards, say, green transition, more socially inclusive economies, there's much to consider in this year ahead in terms of investments. So we see the global economy heading into the expansion phase of the cycle, with some countries like China, the US, and Korea already in the mid-cycle. Typically, this means we are already past the peak of economic and profits growth, and inflation will pick up, as we have already seen, quite elevated, while policy begins to normalize. So our central scenario of the global growth and inflation mix is still reasonably constructive, but there are significant risks to the demand or supply side. So a negative demand shock could come from, say, new COVID variants, renewing or tightening restrictions, particularly as emerging markets still, mostly under-vaccinated relative to developed markets, despite good progress in some countries, particularly in Latin America and Asia. The risk of stalling economic recovery could also come from a sharper than expected China growth slowdown or broader financial contagion from the credit stress of several Chinese property developers. Even with eventual policy support, this risk would damage the outlook for cyclical parts of the stock market. On the other hand, in terms of the supply side, recent survey data suggests supply chain constraints are easing, with Asia and auto production leading the bounce. However, Omicron poses risk of renewing manufacturing bottlenecks in the near term. Supply side risk could particularly come from more protracted impacts from distortions in global labor markets due to a post-COVID economic scarring. So the social and inflation implications mean policy may have to be adjusted more aggressively. This could potentially cause heightened financial market volatility. So in terms of inflation, the pandemic-induced supply-demand imbalances with the strong goods demand recovery and supply-side bottlenecks may continue for some time into early parts of this year. So we would likely start to see quite elevated inflation readings in Q1 or even first half of this year. However, we still think many of the temporary factors that are, boosting inflation now, for example, autos, energy prices, housing, etc., should shortly peak. As you can see from the left-hand chart, we are looking at different kind of drivers for inflation. And by the time we get to the middle of this year, with supply chains being repaired, these factors may even become sort of a disinflationary force on consumer prices. From then, the principal driver of inflation would become wages, given very tight labor market conditions, especially around developed markets, in particular US, and inflation expectations. So rapid labor market tightening given and also elevated inflation has prompted quite hawkish developed market central bank policy shifts, particularly recently by Fed. Monetary policy conditions will likely change quite materially this year as massive central bank asset purchases are ending and policy rates will rise in much of the world. We know that the Bank of England already hiked its policy rate, and very strong December employment increases. The employment data increases the risk that the Bank of Canada could raise interest rates soon. The Fed is set to end its QE taper in March and initiate multiple rate hikes this year. The latest Fed meeting minutes also revealed that policymakers had a fairly extensive discussion around balance sheet policies. Even though policymakers generally still agree that the balance sheet reduction or the so-called quantitative tightening QE would not start until the hiking cycle is underway, most of them also agree that the run-off plan could proceed more rapidly than during the global financial crisis era, and to commence fairly soon after the central bank begins raising interest rates. So this could definitely pose some challenges to the financial markets. Meanwhile, global fiscal stimulus will likely contract this year as well. So in Asia, inflation risks are also tilted to the upside in the near term due to supply side pressures and the potential spillover on inflation expectations. However, service or core inflation have been more modest given muted demand side pressures. And on the back of negative output gaps, even though it's gradually normalizing, given the economies are reopening. Having said that, inflation risks should be more manageable compared to the developed markets world, given more calibrated reopening strategy we have observed across the region. Less aggressive pandemic era policy stimulus, as well as policy measures to mitigate the energy cost pass through, for example, subsidies or a more rigid pricing for fuel prices or fuel taxes, and better management in terms of food supply. As such, we would think the domestic macro policy would remain overall quite supportive of growth in the near term for Asia, but policy support is still being gradually reduced. fiscal consolidation is expected as economic recovery gains further traction and inflation rises, but we still think targeted measures are still likely to remain in place to support vulnerable segments of the economy. And also in terms of monetary policy, looking beyond pandemic risks, overall better growth prospects, especially the growth catch-up potential for ASEAN countries, combined with some inflation worries and negative real policy rates, will likely drive broader, yet still quite gradual policy normalization across most parts of Asia this year, as you can see our expectations on the right-hand chart. Against the backdrop of Fed policy tightening, financial imbalances risk, particularly arising from rising housing prices, further leverage build-ups, and a prolonged period of very low interest rates also have a major bearing on several central banks' policy decisions, for example, Korea and New Zealand, etc. So backing the regional trend in China, we will expect both the fiscal and credit impulses to turn more positive in 2022, which will support growth. Fiscal policy in China will likely focus on target support to SMEs and priority manufacturing sectors, another round of tax reductions and also infrastructural investment. We also expect more employment first pro-consumption policy measures to come as well. Monetary policy will likely be calibrated to ensure sufficient system liquidity provision, strengthen targeted credit support to priority sectors and also projects, and also provide some sort of policy backstop to protect against systemic risks. We would expect more housing policy fine-tuning, even though that will not be stimulus, with more implementation flexibilities and some city-specific policies to limit the property downturn in China as well. So I want to talk a little about sort of the sensitivity of EM or particularly Asia to a rising in yield environment. So in a simple conclusion, a Fed tightening cycle does not always necessarily equate to a negative environment for emerging markets, but it does add some pressures on EM asset performances. So the impact will likely also quite depend on the speed of bond yield increases, particularly with real rates mattering more than nominal rate. Here, we use a quite simplified heat map in an attempt to gauge selective Asian economies' sensitivity to rising US Treasury yields. So we know that EM Asia's external balances in terms of, say, current account balances and FX reserve buffers have improved. This reduced the risk that Asian central banks would have to tighten monetary policy disruptively given rising US rates. However, macro fundamentals in terms of debt metrics and fiscal imbalances are higher than during the most recent Fed tightening cycle. The growth context also shapes EM's sensitivity to rising US Treasury yields. Usually, for past experiences, periods of above trend real export growth and also rising commodity prices typically would see EM assets holding up better, far better. Now, for this year, we see the growth differentials between developed markets and emerging markets, or the so-called relative growth advantage of developed markets relative to emerging markets. What we observe in 2021 is likely to begin to erode or fade in 2022. However, Omicron's higher transmissibility also leaves EM more vulnerable to further waves, potentially delaying their recoveries. Export strength in Asia is also likely to fade as global goods and supply demand and imbalances ease, even though some easing of supply bottlenecks and also near-term restocking demand would still be supportive for continued positive export momentum in the region. On the valuation side, still Asia's decent real interest rate differentials relative to US currently will help to buy some protection against capital flow volatility. We think cheaper relative equity valuations and also the quite sizable valuation cushion in long-term EM bond yields following a sharp move higher last year, actually may help EM assets avoid a table tantrum-like scenario. Actually, last year's sell-off in local currency bonds already quite equivalent to the size of sell-off during 2018 Fed QT period already. So, overall, we think investors this year will have to navigate the many economic and market uncertainties. We still see a solid investment case for equities, particularly against government bonds, as we expect long-term bond yields to move gradually higher given policy normalization. Stocks typically beat bonds when labor markets are improving, which we are observing currently. We do definitely need to watch the risk around a potential profit margin squeeze due to rising input costs. But for now, financial conditions are still supportive. The equity premium is still fairly reasonable, we would say, and profits growth continues, even though we would expect some moderation ahead. Rising bond yields should favor late cycle and value equities if we look at the factor exposure. For example, Europe and Asia will rank more favorably in this regard. But given the macro complex uncertainties, as we discussed, we would think the optimal strategy is to adopt a more cautious barbell approach, sort of investing in defensive stocks, for example, quality factor, ESG, digital sectors, etc., alongside the cyclicals. This is our strategy for equity investments on a broader scale for this year. So, parts of the emerging markets also appeal in terms of valuation, particularly in the fixed income area, given the search for yield. The case for owning renminbi bonds relative to global bonds remains quite strong, both for superior carry and portfolio diversification purposes. The future return profile of Asian credits, where spreads have increased quite substantially over the past year, looks also attractive, as you can see from this pecking order chart. We rank the risk expected return against their expected volatility here, especially compared to what we see in the US and Europe. But of course, a strong credit research process is essential to assess issuer fundamentals to invest in this market. In periods of higher inflation, the performance of stocks and bonds tend to sort of become more closely correlated. So this is one of many reasons we think alternatives will also be particularly useful in diversifying portfolios going forward. We would focus on the real strategies to support sort of inflation hedging. These asset classes could include global and Asian real estate, infrastructure. They look actually quite attractively priced and also quite consistent with our mid-cycle economic theme. Alternatives that can also offer a direct pace to invest in a net zero transition. So altogether, to conclude, 2022 looks like a more challenging environment for investing. Strong recent returns in markets mean that yield spreads and risk premium have all compressed. This leaves us with higher valuations and lower margin of safety. It's important to have more realistic expectations for the markets and the economy going forward. But still, there are a number of interesting opportunities for active investors. So this year, maybe not so much about beta investing, but more for active management to get to generate more alpha opportunities here. So with this, I'll conclude my presentation and hand it over to Alex.
Thank you, Renee. Thank you very much. And you stole my opening line by talking about active management, which is great. A very interesting final chart there from Renee, and particularly if you think about a couple of elements that we've seen within the markets. If you were looking, you'll see that China A shares, China 8 shares, and Asia, thanks Renee, all sit in the middle of that. So they're offering a relatively attractive expected return versus other asset classes, but with a higher degree of expected volatility. And I think that's really a theme that really does support this view of active management. We're seeing far greater stock dispersion, particularly over the last 18 months, and particularly within the China markets. So I'm going to start with China, if I may, and just very quickly think about common prosperity. It's been very much in the news. We had two kind of main events over the last 18 months within China. One was the announcement of the most recent 5-year plan, which was the 14th 5-year plan, which I'll come on to. But we then had this focus on common prosperity. And there was a real interest in, well, what does this actually mean? And to a high degree, a number of companies and commentators are still getting to grips with all of the elements of this. But there was very clearly a policy reset. This was towards a more balanced growth and a higher degree of sustainability. Now, what did that mean in 2021? Well, there was quite a focus on a number of elements here which related to regulatory action. And this created a high degree of uncertainty and volatility. And we saw that. We saw that with the focus on the education sector. We saw it with the focus on some of the tech giants, and particularly those tech giants being listed in overseas markets. So that we really had a high degree of volatility, some quite substantial and noticeable sell-offs. But the other element with this, which is a far more positive element, is this focus around the environment, sustainability, the green economy. And this, I think, is an area of real investment as we go through. So I'm going to talk about 2 or 3 strands of this over the next 5 to 10 minutes, and then I'm going to finish on the healthcare sector globally. So if we can just move one slide, please, Renee. I think a clear thing for us is that prosperity is as important as common here. This isn't a drive the drive towards inequality is to bring everyone to a level, but to continue to have companies that offer quality and growth. So really resonating with some of Renee's comments here. And that means we are going to see this kind of, some of these actions to try and stop that kind of excessive froth. But at the same time, we are going to continue to see the government and companies continuing to prosper, continuing to deliver returns. And the market is going to continue to be good. And the key thing, I think, and I've seen one of the questions in the boxes asking about this, is that the China equity market, if we're saying is broadly delivering 5%, it will be an unequal set of returns. There are certain sectors which look very, very well positioned as we go into this market, be that through supply and demand or through just the nature of the Chinese economy. They may well deliver considerably in excess of 5%. There are others which are going to be far more challenged because of the nature of where we are, because of maybe the inflationary environment, or just some of the headwinds. And the real estate sector in its totality might be one that we would point out as we go into 2022, although government policy has been more supportive towards that. So as we sit here, Chinese tech sector is sitting at a real discount to the US tech sector, about 18%. Due to more muted performance in 2021, China in itself the Chinese equity market is sitting at a considerable discount to both global equities and also particularly US equities. So if we can move on 2 slides, please. I'm going to focus a little on disruptive tech and what that really means. Now, we talk about digitalization, and I'll talk in a little about the supply and the dynamic of the actual economy. But if we actually look at this and think about GDP growth in China, and we think about the digital economy, this is still a very high, there's still a high degree of growth opportunity for the digital economy. And the pandemic has exacerbated this situation. It's shown and pushed this idea of how can we benefit from e-commerce. It's really pushed us towards the electronic and digital economy. But at the same time, we're still seeing this shift within the broader China context from a broad-based agrarian economy towards very, very high development of urbanization. But that continues to go on and continues to be very much encouraged by the central government. So that share of the digital economy that from GDP will continue to grow, and I think is a real focus. That digitalization is part of that. And again, it resonates with this idea in the plan, the 14th 5-year plan, of the dual circulation, trying to really benefit from the internal economy whilst maintaining the connections that have been developed for the external economy. So moving ahead, well, what does that mean in terms of the way that the market has developed within MSCI China and the Chinese new economy? Renee, if we can just go on 1 slide. What we're seeing is that the weighting within MSCI China towards the new China, the new economy and digital sectors, has gone up dramatically. Now, we're looking at this at 2013, that's down at 20%. It's more than doubled within 7 years, 6, 7 years. to close to 60-65%. We see that on the left-hand graph. So, old gives up to new. And on the right-hand side, we see, well, what does that actually mean from some of those sectors? And we see that internet sector has really grown dynamically. Now, clearly the pandemic has had an impact on that, but you'll see that movement and that change was taking place 3 or 4 years prior to that. And we've seen that reduction in the impact of typical cyclical and value sectors like financials, and that move really towards the digital, the more newer economy. What does that really mean for us? Well, it means that we are starting to see a number of these key areas come through. And the two areas which I think are really interesting from the perspective of green, which is something Patrice talked about, the environmental, social governance, particularly the environmental area. There's a talk, there's this aim within this plan to be at peak emissions by 2030. That's now 8 years away. That's a real focus, and that's going to be where a lot of money is being put to work. It also has an important impact in terms of supply chain, in terms of the kind of reliance on that. And at the same time, this dual circulation is saying, well, we want a higher degree of self-reliance. And we want that in areas like semiconductors. We want it in areas like IT. We want it in areas potentially like healthcare, although I think there is still some way to go on that in terms of the Chinese market. So it's supportive of those changes. So I'm going to whistle stop through a few of these now. But looking at the bottom left, common prosperity, consumption upgrade, tourism, mass market consumption are all areas around this particular theme. And mass market consumption clearly has been a big driver, with China being first in, first out initially of the pandemic. Tourism, I don't think, is going to pick up quite as much given some of the issues with the zero COVID policy at the moment. But we did see a very, very strong recovery in the airline industry during 2020 into 2021. And in fact, at one stage, we were seeing consumption and flights booking at a level that they began at 2018, 2019, as we went into some of the singles days holidays and others in there, and higher singles day sales we'd ever seen. On the right-hand side, the green economy, carbon neutrality, new energy, electric vehicles, these are all areas that we're very, very highly focused on within our portfolios, and particularly from the perspective of electric vehicles, also autonomous driving vehicles. And that drives out a number of these elements that sit in this middle of the digital economy, applications, software, the components that go within that. Within the internet sector, we see certainly probably less social media. There's quite some degree of scrutiny on that, but the gaming and e-commerce sectors have seen a fairly hefty revaluation over the last 18 months. And I think selectively some of those now look quite attractive, and the regulatory overhang probably looks less than maybe it did before. So this I find fascinating, that China dominates the global technology production. So on these slides, as we see them, iPhones, the capacity in terms of what's driven out is almost entirely driven out of China. The demand is coming from the US and the world outside of China. Now, clearly you have 1.4 billion consumers within China as well, so there is the potential demand within there as well, but there's a real sense of manufacturing to distribute beyond the realms of the kingdom. Similarly for notebooks, a computerization, same here. High degree of capacity servers, TVs less so, and then again gaming consoles. So a number of these elements that are really important and have picked up dramatically over the last 5 to 10 years. The current production levels and the demand is very much external demand to a high degree of production, so it remains very attractive. And we continue to see ample potential for spending. And again, I highlighted semiconductors here and hardware as benefiting from this. We've had some real supply constraints around that, and that really has been something that's generated good value for those companies. We can also see that the relative level of spending within China versus the US is still considerably lower. So the potential for growth is enormous here. This is on a sector basis versus that headline figure. Rene talked a little bit about maybe a more muted return for China, but that's not across the whole piece, and there are certain elements here, but we can see really strong nominal growth as we go 21 into 22. If we may move on another slide, please, Renee. So these are my last two on China. One is that advertising and globalization are very much key, and we see slight typo here, a 26% CAGR combined annual growth rate in the next 3 years for the online advertising market. Again, the pandemic has really focused us back onto that online scenario. And an area we're very focused on is this secular growth for Chinese games publishers, and this is an area within our portfolios we've been gradually taking more exposure to. We were very cautious during 2021 with a lot of that regulatory overhang and had much higher cash positions. But as we've moved into late 21 into 22, we've been deploying that cash more selectively, trying to increase our exposure in some of the games and console makers, and also some of those internet names with high platform ability. And then, those platforms clearly have a big advertising spend associated to it. And the final slide for China is just around cloud computing. So the adoption rate is expected to rise to 26%. But I think the chart on the right is the one that I really like here, which is 402 billion of spending within China versus 1.2 trillion in the US. So 3% plays 10%, but on a population of 350 million versus 1.4 billion. So roughly a quarter of the population. So I really do think that the cloud has a real way to go. So again, selectively, as I showed you on with that digital vertical, and then these areas around cloud computing, around hardware, around semiconductors, these are all areas with substantial room to potentially grow in that technology and hardware sector. And they're feeding into areas, including the green economy, which are really users of that. So exciting opportunities on a stock by stock level and in certain sectors, but a rising tide is unlikely to move all of those sectors. So we have to be selective and we have to be careful. Now, for the last 5 minutes, I'm going to move across to the healthcare sector, and I'm going to talk in a more global context. And I'm going to talk about an area and a kind of approach that we're very much championing to our clients around how we can make healthcare as a sector globally sustainable. It may not come as a surprise to many of us that the healthcare sector, the market has continued to grow. Demand has grown. Why is that? Well, there is a rising middle class throughout Asia, throughout key economies in Asia, including the most populous of India and China. And obviously within the more developed markets, in terms of the way that they are positioned within our indices, the US, the UK, Europe and beyond. But healthcare spending is massively outpacing GDP growth. And this puts enormous pressure on healthcare systems. And what it effectively amounts to, as the narrative says at this bottom right here, that 43% of patients miss a dose or a medicine due to cost or other factors. What does that mean in very simple terms? We are not getting the treatments that we should due to cost constraints. Well, what does that mean to us? It means that unfortunately, there is a disconnect between the companies that seek to deliver, some of which may be on the left, it's not all, and may appear to be good candidate companies, and the costs that they're charging. And this is particularly when there's no clinical rationale for increasing cost, but the cost is just increased for the sake of it. And that cost increase reduces the ability of patients to get that outcome. Why is that? Because the healthcare system is somewhat unique in that the doctors who prescribe to us as patients, we aren't typically paying, and the doctors have limits on what they can prescribe that are put on them by those that are paying, which will typically be national health systems or insurers. Now that means that we don't get what we would like, because the industry needs to recover its R&D expenses, and in order to do that, they need to turn a profit. They're typically funded by venture capital, private equity, or us as shareholders. So this is a very kind of inefficient circle as it sits. But what we need to move it towards is one where we have good clinical differentiation but lower cost. What would that mean? It would mean the industry recovers its R&D quicker. It would mean that patients get access because doctors don't have limits put on what they're able to prescribe. And it means that as investors, we benefit from the company, but as patients and the healthcare system, we're getting the treatments that we need. So if we can move on, I'm going to give 2 quick examples and then I will hand to Q&A. So what we're saying here is clinical benefits plus cost savings equal a more sustainable system. And on slide 27, I hope, if I've got my slides correct, I want to give one example here. This is a US biotech company. It does a best-in-class novel therapeutic that's there to treat migraines. Now, it may come as a bit of a surprise, but migraines actually have an enormous impact on the economy on the basis of they really do knock a lot of people out. They stop people who have constant migraines from being able to drive, use technology. It seems, relatively small area, but actually it is very, very problematic. This particular drug that is available to treat that is easy and seems to be much more effective at doing that, but it is much more cost effective. Now, on the box here, you see a high degree of clinical differentiation, 3 pluses, plus also the cost savings. So it's cheaper and it's giving a better patient outcome. Now, from a share price perspective on the right, that also has meant that it's benefited considerably as that's come greater to market. But it's a classic example, Biohaven, of this ability to be able to deliver better outcomes to patients, doctors, and ultimately, therefore, to shareholders and the overall ecosystem. The second example on the next page, Rene, is one that is kind of close to heart due to a couple of friends of mine who suffer very badly from this. This is sleep apnea. Anybody who's aware of sleep apnea will know that the typical way you combat this, sleep apnea is where you're not breathing properly, your airways are constricted, and you end up effectively holding your breath for a period of anywhere between 30 seconds and a minute, which of course causes you to get to an almost near-death experience, then take a huge breath. What does that mean? Well, you never fall into deep REM sleep. If you don't sleep deeply, your body doesn't recharge. If you don't recharge, you become actually significantly ill, and that can have a really adverse effect over time. The way of treating this has typically been a mask that fits over your face, which is neither attractive for you nor attractive for your partner, and is very difficult to move around, and it sits with an oxygen unit by the bed. It's quite invasive, it's quite difficult, not hugely helpful. The solution that Inspire has come to, which has a very high degree of clinical differentiation, but remains lower cost than this, is a device that's implanted to the chest, and it actually allows you to breathe on in an uninterrupted fashion, but it triggers a response when it sees that you're starting to do this breath holding that goes in there. So far smaller, but far better in terms of being able to wear, in having a better outcome, and also working within the body's overall functions. So again, very interesting for us, sitting in this top right quadrant of clinical differentiation and cost savings. 2 other examples I won't go through, but would sit firmly in this, are ones that we're all very familiar with thanks to the pandemic, would be Moderna and BioNTech mRNA technology to deliver vaccines to billions globally, which have proved hugely effective against COVID, and including the multiple variants that we've seen. Many of you may be aware, some of you may not be aware, that the mRNA technology was actually originally developed as potential to try and help with the treatment and overall cure of cancer. So the additional potential clinical benefits of that post-COVID are hugely high. So if we may move on a slide. I've run out of time. So just to say that, what we're looking at in those kind of portfolios is this top right quadrant with high clinical differentiation, high cost savings, which enables us to have a balanced portfolio of companies that are increasing the sustainability of the healthcare sector. And the final slide for me is just that this also really for us is part of this move towards a more sustainable world, a focus on environmental, social and governance issues. This is particularly for us in this around the social issue of sustainability and the governance issue of engaging with companies that we see not supporting this system and trying to move them in the right direction, and very much focused around the sustainable development goal of the United Nations around ensuring healthy lives and promoting health and well-being for all ages. Now, within that, I'm going to hand back to Joanna for the Q&A. Thank you very much.
Thank you, Alex and Renee, for sharing those views and insights. Just a reminder that should you have any questions, do feel free to put them in the Q&A tab. Alex, I can see that we have some questions here. Let's start by answering the first question. The first one that we have, what is the possibility of the high inflation in US triggering a recession this year?
I might let Renee talk about that one first, as she's done a lot of work on, and her team have done a lot of work on the impact of inflation. So Renee, maybe if you want to pick that one.
Yeah, sure. We think the probability is quite low. Of course, elevated inflation with entrenched inflation expectations could eventually feed through into profit margin squeeze, hurting corporate earnings, etc., and also maybe damage, consumer purchasing power. But still, we know that consumers in US, they have quite solid balance sheets. They come out of pandemic with quite excess savings, and also relatively lower debt ratios and quite resilient balance sheet is mentioned. So we still think there's a lot of momentum in the US economy. Consumers, business is still very dynamic kind of business models. So we do not think the risk is quite that high for a recession, but definitely there's a sufficiently high risk that a protracted period of heightened inflation would eventually erode corporate profits and dampen confidence and potentially pose some downside risk to the economy. And that's why we have seen quite a material hawkish policy shift by the Fed in recognizing that they could potentially be a bit wrong underestimating the sustainability or how stubborn the inflation is in the US, and also how quickly the labor market tightening is actually for them to really achieve their dual mandate for a policy tightening here.
Thank you, Renee. The next question we have is on technology. Technology has proven to be one of the most important sectors during this pandemic. Some investors are, of course, concerned with the high valuation. What are your advice to these investors?
Yeah, I mean, I think I alluded to that. There is a high degree of dispersion as we look globally between, for example, the US and China, even within the tech. There's about an 18% valuation discount. Renee really hit the nail on the head with one of her sum ups at the end of hers, which is it really is about stock by stock. I can see another question in there about the China A ETF, China A50 ETF. And, if I was answering that, I'd say, look, that's very interesting on a tactical play if you think that a group of large cap stocks are going to perform very well for a short period of time, but you're not getting necessarily the diversity, and we're not necessarily seeing that kind of beta rally. Intra year you may get that, but market timing is hugely difficult. I think within the technology sector, as I spoke about, there are some individual pockets of that which are hugely supported by both the macroeconomic picture and other incidental factors. I can see another question that we've got around supply and demand dynamics in the chip area, and we are going to have supply constrained for chips. I think I would certainly see that into 22, maybe into 23, which is going to be supportive for those particular companies, and is also going to continue to kind of phase into those to the areas that they're actually placing within, because it's going to create some kind of slowdown and therefore a bit of a dynamic of people wanting to get a hold of that. So it creates that kind of pressure to the prices. So I think the technology sector as a whole within the China market is interesting. As I said, we've gradually started to reweight a little into the internet side. We're still slightly cautious around some of the e-commerce areas because of regulatory issues. So I think we want to be cognizant that there is still the potential for some challenges in there. But I think within the green technology area, the EV area, autonomous driving, semiconductors, these are all things that we see as being reasonably well supported into 2022.
Thank you, Alex. Moving on to the next question. The Chinese ADR has been beaten down with rumors from the listing in the US markets. What are some insights that you can offer on this topic?
I mean, certainly, yes. There's been a lot in the news. I think there is probably going to continue to be the potential for a number of firms to look at dual listings. We've seen that with listings into the Hong Kong market. We've seen that equally with some discussion around listings into the A-share market. there's an interesting dynamic among a number of the ADRs that I think are out there. For one or two of those companies particularly, they've created what affectionately used to be called, when I was a younger investor, I think Patrice was nice to call me young earlier, but that's probably because I paid him enough money, that we talk about moats, that kind of barrier to entry. And in the technological age, if you develop a platform which has the ability for to deliver multiple things, but once you've created that infrastructure and you have a high user base, it creates a barrier to entry. So I don't think the number of those companies that initially ADR listed will have gone away. And in fact, the core business of Alibaba looks quite interestingly valued at the moment, as an example. But I do think that if the general desire around common prosperity is to try and make a little bit of a move and bring things, reshore some of that, there is more likely to be a focus. And we saw a number of articles around the potential benefit to the Hong Kong market if they can attract more listings. We saw a lot of listings on Hong Kong last year. So I think there's a number of elements at play here, but I think that dual listing is probably one of the things that we've seen more of more recently. My final comment, I think, is also that there remains quite a difference between the domestic A-share market and the H-share and even the ADR markets, in terms of the A-share market really is access to domestic China, whereas a number of these other firms, they've become very big and they've become bigger than just that domestic market. They are aiming to appeal to the broader Asia market, to have tentacles into the global market. And in that sense, you can see why dual listing would suit them well, having a foot in the Asia camp for that, but having a secondary listing or a primary listing somewhere else enables them to have, a greater liquidity pool and ability to trade in multiple time zones. Renee, I don't know whether you want to add anything to that.
No, I think your answer is very comprehensive. And when you speak about the Hong Kong markets, we know that there could be some initiative, for example, southbound ADR inclusion that could be beneficiary for Hong Kong markets as well. So I think at least China is still continuing with this, capital market liberalization agenda that could also be a bit of offset in terms of these uncertainties around US-China issues here.
Thank you for addressing that, Alex and Renee. The next question we have is on ESG. Alex, you spoke a little bit about the ESG team. Will ESG be a big team and one of the key investment focus in year 2022?
Yeah, I'll do a quick couple of minutes on this. And Renee had a really interesting slide about how that impacts the macroeconomy, which I think is worth going back to. There are two elements to this. Regulators are very, very much focused around how we, as investors, as asset managers, as well as broadly, both focus on ESG, environmental, social, and governance. And I think that particularly as we've seen a lot of polls around millennials, the way that they invest is perhaps different to people from Generation X or otherwise. They're very, very focused on doing good. Historically, the idea of doing good was disconnected from the idea of performing well. But what we've seen very clearly is that high quality companies perform very well. So well-governed companies will deliver good performance because they're doing the right things. So that's the first part, that good governance will give you good performance over time, and it should do. You want that from the companies you do. But ESG as a broader theme is embracing areas around climate change, which is critical for us to invest in, be that in individual projects or more broadly within equity or fixed income funds. It's looking at areas of social, so the sustainability around healthcare that I highlighted. These are all things that I think intrinsically are critical to the way that we develop our planet over the next decade. So is it important for us as HSBC? It's hugely important in everything that we do, but it's integrated into everything that we do in pretty much all of the funds that we run, whether they be more plain vanilla Asia or China funds, or whether they be very, very specific funds focused on climate change, circular economy, sustainable healthcare. So you're getting this twofold thing where ESG is critical to your what you do as an investor, and then you get the thematics associated to that, which enable us as investors into that. Me, if I was putting my what do I want to do with my money hat on, is the ability to be able to either asset allocate safe in the knowledge that my managers are doing the right thing, or even look at thematics and start to tilt my portfolio so I can really focus on some of those areas that I may want to deploy capital into, where they're making a difference to the planet or the social element or otherwise. But I think there's another element to that, which is how ESG then plays into the macro. So Renee, maybe I can hand back to you.
Yeah, I think Alex already addressed most of the important points, but I think if we look at asset class returns, we plot the expected return against expected volatility for ESG mandate or ESG fund or index. Actually, ESG funds have or index have a more sort of quality defensive tilt, but actually you don't get much compromise on returns as well. So definitely it's very good investing. And from a more macro perspective, definitely ESG is a big agenda across many countries, US, Europe, China. Every government are having this socially inclusive agenda, and also net zero, green transition, etc. So if from macroeconomic, of course, that's a lot of implication in terms of, say, when you invest commodities, they are closely tied into this net zero transition, or sectors that are actually getting more policy supports in this kind of policy agenda. Perhaps will be some sectors that will give us long-term deliver, longer-term, more speculative structural returns for us to select to focus as well.
Thank you, Renee and Alex. So we can move on to the last few questions. One of the questions here is that with the pandemic still raging in most countries, it has continuous adverse effects on certain industries. Do you think value stock hold the edge over growth stocks in terms of long-term economic recovery, given that most industries have learned how to navigate through this current economic uncertainties?
Maybe I'll have a go at more broad level, and Alex can elaborate.
Yeah.
So I think as we discussed in terms of our strategy in equity investments, broader strategy for this year is a more barbell strategy. So in the near term, indeed, this pandemic raised the overhand here may actually delay some of the recovery in certain industries. They are more tilted towards service contact, heavy services, tourism, air, international travel, etc. So certain industry may not be returning back to the pre-pandemic level until quite some time later, and so there will be a bit of worry in terms of cyclical value exposure, whether this kind of what we call expansionary phase of the cycle will get a bit of setback. But we still think the pandemic, the variant shock will be short-lived, because now, as you also mentioned, the governments, businesses, consumers are more adapted to this pandemic. Many governments already adopt this sort of endemic kind of strategy, living with the virus, and more, we have higher vaccination rates, we have more effective treatments, hopefully, etc. So the economic fallout should be smaller and more short-lived. So looking beyond very short-term uncertainty driven by the pandemic, going into the second half, or over the course of the year, we still see values in some cyclical parts of the equity market, and that's what we say. We want to also have exposure to some of these value and cyclical tilt markets, for example, in ASEAN or parts of Asia. But at the same time, given the lingering macro uncertainties, we also want to have a exposure to more quality defensive segment, digital transformation, and also ESG, high quality stock, etc. So it's kind of, for us, it's more mixed strategy in terms of a bit of defensive, but also we will look at the selective opportunities in more value and cyclical parts of the market investment universe as well.
Thanks, Renee. I mean, I think one of the two observations I make, particularly when we talk about value, is that if you proxy the word value for cheap, you have to work out sometimes whether something's cheap for a reason, or whether it's just that the market is underappreciating the opportunity. And I think for us, we'd be very focused on quality companies with good business pipelines and good cash flows that seem to be inappropriately priced. To back up exactly what René's just said, that to us cyclically seem that if they are picking up and they've got a good business model, then actually that's a misvalued company. We probably, certainly in the auspice of our China portfolios, I think we're a little bit more cautious at the moment on inexpensive companies that are reliant on a business model where there isn't a lot of cash. You know, it's not just jam tomorrow, it's jam a long way in the future. You're waiting a long way to get your cash actually coming in. So that I think would be more concerning at this point in the cycle. So I think for a number of reasons, we like quality companies. We like quality companies with cash flows, and we like to think where the business model is supported by that, and then work out the relative, work out that valuation either relative to the global opportunity or relative to the local opportunity, within the Asia context or even within the China market, looking at, different stocks within the sector.
René and Alex. The next question we have here is on healthcare performance. The healthcare performance has been laggard in the year 2021, except for some companies that are, of course, associated with the vaccines. What are the factors that will turn the sector around in year 2022?
Yeah, it's a very good question. Historically, the healthcare sector has actually outperformed the broader market over the last 10 to 15 years, but it's been more challenged this year. I think one of the comments we made earlier on is it's around, a lot of it's around stock selection. One of the catalysts for us, at least, is we could point to at least 3 or 4 portfolio companies that we look at who've come out with hugely impressive clinical trial data. So kind of they're really making good on what they're due to do, and the market sold off. So if we come back to my comment of about 3 minutes ago, you've got an undervalued company that's clearly got an edge, that's going to deliver something that is going to make a difference. But at the moment, the pricing doesn't seem to be reflecting where that is. So I think that will change it. I think large cap in the healthcare space was somewhat more resilient, and small and mid cap was quite a bit more volatile. And I certainly think there's the potential for that to revalue during 2022. And there are a lot of interesting portfolio companies out there. The healthcare sector itself goes through a pretty large conference during January, and quite often that sets the tone for what's going on. That's been going on over the last 5 to 7 days, and there's been some very interesting stuff coming out of that. So I think, valuation at a level may drive certainly a bit of a catch up between mid and small cap towards large. I think the fact that the market had underperformed gives it some room to catch up in 2022. And I think there will continue to be, if we look at that, there will continue to be quite a high degree of dispersion. And for us, that's an opportunity, and that's interesting. It may not be that the healthcare index is the thing to be in. It may well be that there really is more granularity around the individual stocks that do best.
Thank you, Alex. Moving on to our last question for tonight's webinar. Will there be a global stagflation?
Maybe I'll take this question. I think first of all, what's the definition of stagnation? I think we need to clarify. We would say maybe current environment will look more like a slowflation. You have a slower growth and higher inflation, but not really necessarily stagflation. The difference may lie in that stagflation, usually you will have a demand shock or burst supply demand shock. But at this stage, most of these inflationary pressures are actually supply shock, supply chain bottlenecks, disruptions, labor market, you will say overheating to some extent, etc. So at this moment, stagflation is still a tail risk for us, and the risk we are not seeing the current environment as being working towards that direction. But of course, it's in select emerging markets, maybe the characteristics of stagflation may already have been met, and that's why over the past few year, we already saw some emerging markets were forced to tighten more aggressively, and their currency or some of their asset markets got really hit by capital outflows, etc. because of that. But broadly, even if we say US, which as we discussed earlier, there's still a lot of momentum in the economic expansion, and also some of the economy, for example, parts of Asia, ASEAN, is still in a catch-up growth phase, and particularly in Asia, inflation risk is still quite manageable, as we discussed earlier. So broadly, we don't think the risk is that high that we are heading into stagflation, especially given our view that inflation should start to fade or taper off around the mid of the year. But of course, we cannot rule out the risk that inflation gets more entrenched, and that could have consequences on expectations and some on profit margins and further growth momentum, etc.
Thank you, Renee. This brings us to the end of this virtual event. Thank you very much, Alex and Renee, for taking us through tonight's market outlook for the year 2022. We hope that this evening's session has been beneficial in helping you to meet your investment needs, and we look forward to supporting you in growing your wealth. If you have further questions about tonight's session and would like to speak to someone at HSBC, please reach out to your HSBC relationship manager or drop us your details at hsbc.com.my/contact me, and we'll get back to you. Thank you, stay safe, and good night, everyone.